Hello YouTube. In this video, we are going to talk about everything that relates to trading edge. And to be honest, I don't know how to actually organize this video, but I think I will just start and slowly build up. So I hope that you can be patient because it's gonna be a lot of numbers. It's gonna be a lot of data because I want to talk about how I use data to optimize my trading decision and what kind of mistake I make in terms of using data and a lot of things. I want to share a lot of things. I I brainstorm and have a lot of idea in here, but sometimes it's just really hard to share it with people in a way that most people will understand because trading edge, it is kind of something, sometimes it is quantifiable, but sometimes it's very intuitive and it depends a lot of experiences and the lesson and the scores that you got as a trader. And some trading edge you can backtest, but there are some trading edge you can only see it in live market condition because backtesting it can only take you that far. There are a lot of hidden variables in a lot of strategy, and without live repetition, live trading, live execution, and then proper journaling to actually categorize the trading and collecting exactly the variable that you believe is going to be helpful in the future, you will not be able to develop a real trading edge. And a lot of trading edge got kind of decay over time. That's the reason why understanding data, how to use it, how to not use it, how to believe it, how to not believe it, a lot of things. The more I talk about it, I can talk like hours about developing a trading edge. It is simple, but in a way it's complicated at the same time. But the more you understand about something, the easier it is for you to actually simplify it. So things usually get complicated first before they get simple. For me right now it's more simple, but when I say it out loud, I realize that shit is more complicated than I imagined. But I will do my best to share about this topic because I believe that no not really no one but plenty of people in the space actually talk about trading edge, but 99% of the time people talk about trading edge just simply a candlestick pattern, a simple ABC step like liquidity taken in a New York section, look for an order block, some kind of retracement, and then targeting the new low, new high, or the previous day high, previous day low, something like that. But the problem of the strategy is that you don't actually have something to back it up, and majority of the time, people, especially the new traders, they come into the market and they see this kind of video and they think that strategy is just simply an ABC step, but simply look for an order block, look for some kind of targets, look for some kind of risk reward. I'm not even mentioning that over time, the more you use risk reward, when you got kind of deeper into risk reward, you need to understand that risk reward is not a fixed thing. It's more like a dynamic value that is going to be changing over time. When you are in a trade and with the new market like the latest movement with with the latest movement of the market, your risk reward is gonna be keep changing, depend on the ATR of the hour, depend on how long you actually are holding that trade. The risk reward gonna be different. So targeting or using risk to reward is not like wrong or right, but it's more like when we make a decision based on something logical, something that makes sense, something that we understand. It is so different compared to making a trading decision based on like I am risking one and I want to like have a three because over a long period of time, if I risk one and target three, I only need to win 30% of the time to be profitable. That kind of argument, that kind of logic, there are a lot of flaws in it, but it took me years to understand. Because sometimes a trading loop, a trading misconception can actually make you go round and round in a trading loop for like forever. And when you realize that it's not the way it is, years already pass by. And that's why having a real trading mentor I think is so important. But here I am, self-taught, and it took me quite a while. That's really why I want to share more about trading edge. And you can see even to talking about the overview of the edge is already quite 7 minutes already, but I would let's get going. All right. In this video, I'm going to use plenty of tools. I just want you to know that I'm not affiliated with any of them. Probably I will include some kind of COT report or seasonality or more data that I believe is gonna be useful for me to actually demonstrate for you how to kind of have some advantage using data and how the more we understand about characteristic personality of a certain market, a certain pair, it really removes a lot of emotion out of the equation. Because the problem is, it doesn't matter what strategy or the edge that we think we have, if we still have a tremendous amount of emotion, that means that the trading edge either is not enough or is not there at the first place. And we're actually trading with randomness. And or we are positioning ourselves to a certain condition that's really beneficial for our trading kind of ideology. But the problem is once the market shifts, we will not be able to replicate that kind of success. And that's why I have a one sentence that I believe, and it happened to me multiple times throughout the years. The moment you get it is the moment you lose it. So having an edge is important, but understanding the underlying data, understanding what really give you the true profitability is what can make us consistent and make us to adapt to the new market environment and survive and really have what it takes to stay in the game. I hope that makes sense. So the first thing I want to talk about is the tool called Asphalt. You can see right here. I think you can find them pretty easily either on Google or Twitter. Here's a link. Anyway, so what are they? I think they're one of the probably the first one in the field that actually kind of make data more friendly, especially with the new trader, the beginner, to have an easy overview of how to understand things. They have a they cover different market. They have a different type of report. I'm not going to like show you all the thing or all the report, because the problem is currently I am trading Go, right? So I want to understand more about Go, and I don't want to go too far from what I am trading, because beside the data usually have some kind of benefit, some kind of trading edge, some kind of probability behind it. But the more you consume, the more you know, the harder is it to actually make a good decision. What I mean is sometimes we think the more we know, the better. But in trading, line execution and butting the reps, it's just as important as having an edge. Because hindsight bias and trading on the left side of the chart, it may give you a good performance, a good statistic, but it will not make you an extraordinary trader or like a killer in this game. So that's why when I say about data, the first thing you need to understand is when you go into this kind of result, it doesn't matter how hard or how easy it is to pull the number you need to understand about the thing you're doing. You need to understand that more data sometimes is not better. All right, so let's going. So the first report I want to show as example a gap fill. So you can see that 95% of the time gap on go on daily range is usually fill. Both gap up and gap down have a pretty much like extremely high filling rate. So if you are not familiar with like what is gap, you can actually scroll down. They have a like a friendly explanation for newbie, and this is where things got very interesting. So it doesn't matter what kind of report that you're going to look for in this app. They have this thing, which is explain to you what is gap up and gap down, and how you can actually utilize it. So you have some recent historical there where you can see, and I think when you click on the chart, you can see more. So there are two things that I like. The first thing, and the things that I like the most, is this kind of explanation, because just by understanding the report and not even using the data yet, you open your mind to new possibility, and like, wow, people actually have the kind of data when they are trading. And the more you rely that people actually using different kind of data to trade, it open your mind. It remind you that we are not the only one that here to make money, and that is extremely difficult. So it is very important to for me right now to actually knowing my place and where my edge is, and by understanding the thing, I really found my happy place. Now I'm going to show you on the chart. So on our trading view right here, using Onda as the broker, you see that today is a week open and we have a gap down. Price actually fill up on the next candle, which is pretty quick. And between Thursday and Friday, we have a gap at around overtime. You can see eventually it fell at New York section. So the gap, either gap up or gap down throughout the data up around 5 years back on S4. You can see that the chance that the gap got filled is pretty high. So one of the thing is you can just saw the gap fill in New York section, right? So we have the gap fill probability. But the question is when the gap usually got filled. We have a Asia, we have a London, and we have a New York at a standard section of a trading day. So the great thing about S4 is that they actually like categorize the data quite deep. You can actually see by fill time. So you can see most of the gap fill before 7:30 p.m. And based on this section here, 7 p.m. is around easier section. So 95 up to 90, 98% of the time, the gap got filled in easier section. So how you can actually kind of utilize this? So we have a two kind of data. The first thing is most of the gap got filled 95% of the time. And 98% of gap got filled in easier section. So let's say you calculate the average true range of the easier section is about for Thursday. Let's say it's gonna be around 100 pips, I think, around 100 pips something. Anyway, when price open in Asia section and it's not filling the gap and it trade far away from the gap. The far is straight away. You can think that this kind of gap before London section, before the Asia section end, it's gonna act like a, a magnet to actually draw the price based on the probability that we have. So it depends on what kind of strategy you have. But for me, in this circumstance, my primary trading strategy right now is mean reversion. And I have a way to actually measure the ATR pretty accuracy. In this circumstance, probably the more price trading higher, the more I'm going to selling it back down. Even I have to DCA. Having the kind of confluences at a gap down here, it's gonna drop price most of the time. It's gonna feel very peaceful trading the kind of mean reversion trade. If you bought an EMA, it's gonna be at some value. It's gonna see some kind of, I don't know exactly the value of EMA, but if I bought a pretty much like short-term EMA, we're gonna see something like this. And when price trading above the EMA at a certain distance, I'm going to sell short and just go back to the mean reversion or a little bit below, or take partial at the EMA and then targeting the next level at the gap, something like that. So that is what I mean by making decision based on the data itself, not just some random things that you cannot quantifiable. Let's say we can use Fed retracement in this case, and if you're trading using Fed, you can see price rejected at the 38 level, and we have the 23 is down here. We have the mean threshold or the 50 level between the two Fed is somewhere in the middle. So we have the gap down here. We have a rejection candle at a Fed level, or the mean value is around the middle zone right there. So I'm gonna short right there and cover right there. And I'm not even using, let's say, hourly ATR. Let's say the candle start at 22, and on 22, usually I target around 50 pips. And 50 pips in this case gonna be somewhere around here. So probably I'm going to get out around 80% of the hour ATR. So I'm gonna get out right here. So I'm not sure if you get what I mean, but having the kind of statistical edge, having the kind of probability, it actually allow you to add more confluence to your trade. And it's really depend on your strategy as well. So I just show you a little bit like some ideology on how to utilize it. I do trade with Fed, but I don't trade exactly like I just show you, because despite the fact that I want to show you a little bit of how to think in terms of probability, how to think in terms of using data to optimize our decision making process, I cannot share my edge. Um, I think that's quite fair because you don't want my edge either, because the trading edge is just as strong as the trader, and even your edge is really good, but then you give it to me and I am just a poor executioner, or I don't have a personality to or knowledge to actually understand your edge, then probably I will just be someone that like to make money but could not make money because I just copy someone else. So that is one of the example. So another example using S4, I'm going to from get field. Now I select this mega section breakout. So as a Go trader, I can validate this pretty too. So when I trade Go, I trade min reversion in Asia and London session, but I trade trend following or high risk reward trading strategy with New York session. So when I see this statistical data from Apple, I know that it's true. So you can see that, let's say you are a cultural sub trader or whatever you want to call your strategy based on false breakout. So in for breakout, people usually wait for a liquidity to check in and then wait for a market strip in structure, wait for then retrace to a fair value gap or to an order block or to kind of optimal trade entry, and then they try to trade to this low, this low, this low, this low, whatever. But the thing is, will you do it? Will you trade like that with New York session when you have a data to show that every time New York session breaks the London high or low, it have a tendency to be a single break. What is single break? Single break means that it break in one side and then stay on that side for the end of the section. Double break is kind of go both way. So it breaks the high and then go break the low, or breaks the low and then go breaks the high. And no break would mean that it's gonna stay inside a linear section 20% of the time. So obviously we're going to stay with a high probability environment and apply a certain strategy that fit with this. One thing you need to understand is that, let's say we are a day trader, so sometimes using a shorter data set is more favorable because we want to stay updated with the current market flow. Swing trader that hold the trade for really long periods, I don't think that they're going to have a much benefit from this kind of data. The only benefit that I can think of is that using the kind of data to time the entry better or time the DCA better for your swing trade. Overall, New York session usually is very directional move for Go. I don't know for other pair or other market, but obviously for Go is very obviously you can go and check on the past. So if you're a high risk reward trader, 1 or 2 trades a day, high risk reward, go right to New York session. You have a team that really a background for your trade to work out really well. So in this case, we are actually using data to identify the condition that our trading strategy is going to try and avoid the environment where our trading strategy is going to suck. So for example, the trade that you're seeing on my account currently is that price trades to around 74% of the ATR of the rand that I usually trade. I cannot tell you the exact value because it's going to affect my trading edge. On average, I will only trade after ATR hitting a certain level, and correlation wise, silver is trading at a pretty strong support or a quickly support level, a key level, and it aligns with a fit level as well. So when price is at a bottom of the range ATR, I will buy it back. And my target, it depends on how long I want to stay in the trade. And I don't want to stay for more than 1 hour. I want to done for the day. And I may or may not trade New York, but I want to done for London, so I want to stay in the trade less than 1 hour. So less than 1 hour, currently from this moment, the average ATR of the price usually moves around 60 pips, 63. So probably I would just target around 60 or less. So it's lining up with the swing high right here. And this swing high, it actually lining up with kind of a third level of the previous impulsive swing. So that's it. I'm done for the day. And you can see quite some buy limit down there. But this ZE just in case price go against me, I will manage to manage my way out of the market. So probably that's done for the day. It's kind of the mentality behind the kind of execution it should base it and trading between levels, and the theory behind is mean reversion. Trading mean reversion, I usually trade against the trend. And in order to do so, I need data to back me up. I need to know what kind of momentum or trend that I am dealing with. From there, I need to decide whether I want to fight the trend or not. In some case, trend is your friend, but in mean reversion trading, I kind of play against the trend. But I'm not going to go some kind of huge trend like this with kind of impulsive candle one after another. With a kind of swing like this, I have a different parameter and data to allow me stay out and wait for a certain confirmation so that I can actually make sure that I can be a little late to the party, but I want to make sure that I want to be on the right side of the V. So this is one of the example when I trade poorly a very short-term trade with a small size. My stop loss is based on ATR, and I'm done for the day. Let's continue. I want to give you a little bit of my thinking in terms of like execution. But to be honest, when you know what you are seeking for, you have a data behind every decision. And because I only trade gold right now, I kind of can do the same for any pair. But the thing is, when you trade only one pair, it have a downside, but it have its upside as well, like anything. The upside of trading only one pair and narrow things down is that you can go very deep. And how deep it is. For gold, I don't only know the tendency of a section because a section, if you tool like at4, probably you can see the correlation between section, but I can actually see the correlation between every single hour candle, every single 4 hour candle as well, and it's gonna be a little bit difficult in terms of checking, collecting data, and filter them in a way that you can understand. And it's gonna take a little bit more time than the the data like get feel and stuff because it's more detailed. So it is harder to collect and it's harder to organize in a way that we can make them from number on screen, just percent and number, but it make you have some kind of actionable step. Just, just by looking at the number, you automatically have some kind of, all right, so Z is where price usually form the high, Z is where price usually form the low. So if right now there's some kind of impulsive move, probably it's on the way to make a new high or new low. So before it's hitting extreme and hitting a certain confirmation that I am waiting for, I'm going to stay out. All right, so when you you tool like Excel or any other tool about data, if you know a little bit about Excel, you can actually find data from other source and then run some kind of tests to see or to validate the data either in a different time horizon or either in a large on a larger scale so that you can actually see deeper. So I analyzes 20 years of data from Onda and around five more than 5,000 trading days, and it found around 358, 347 gap up and gap down. I rerun a few times. Some gap are too small, so they're not really counting into the equation. And to my surprise, the gap down covers the filling percent is like 100%. And when I divide the, it's like I try to see the distribution percent based on month, and you can see right here the total gap up on the total gap of each month of the year, and the percent gap, both gap up and gap down got filled. And here is the distribution in percent based on every weekday, and so the gap down percentage is kind of insane. So you can see a lot of gap happen in Monday, and it's kind of easy to understand because that is a new week, and we can and new week opening usually have some kind of gap, and you can see the percent they actually fill the gap is pretty high, and it is nice to see more data. It's nice to see better performance in April or better performance in the gap down section. But the thing is, I don't think that is necessary. I think it's the only thing I feel nice is that gap is actually something we can actually utilize in our trading strategy and use it either as a target in a section or use it in a way that we can benefit from the probability that we're seeing right here, because obviously such high percent is pretty big, and I ran to, it's like a test to see how big a gap is, and then not a lot of gap that usually larger than $10 on gold, but there are plenty that bigger than $1. And overall, I think it is something that you can actually utilize in your strategy, but you only need to know that most of the time they are filled with very high probability. In this case, it is more than 90 or 95%. But you don't need a lot of data like this. It's, it feel like we know more, but the question is, can we put the data into action, or more data doesn't mean more profitability in this case? Obviously, I don't see how I can actually utilize this like better than just basic understanding that most of the time gap got filled, and we have a gap down have a more chance to be filled than gap up, and that's it. That is the only edge that I need to remember. If I try to remember, or if I try to giving the kind of data some kind of memory in my mind, it just slow me down in terms of line execution, and this is not something useful in live trading. If I am selling you a course and I'm trying to go deeper, it look pretty cool to see 100%, but they're kind of not necessary in terms of live trading, to be honest. It look nice, but how how you can actually utilize it better than just simple stat. That's the reason why I say sometimes we don't need to dig deeper. Sometimes we need to go deeper. Sometimes it's not necessary. And this is one of the example. The next example about data is that when we look into GBP, JPY in this case, and we filter the percent by weekday, and we're looking at Monday. So on Monday, 5 years data, New York section. Let's go with the daily. You can see the rand respected is like really go down to 64%. But if we go to New York section, it's like 89%. If we using a shorter data set, we are seeing 96% of the time the rank respected the daily. So how you can actually utilize the kind of stats? Well, first of all, when I do review the kind of report, I think I need to validate it myself first. Because, but I will tell you how you actually can utilize the kind of ATR respected. Let's say if you're trading GBP, JPY, and usually in New York section, they move like 1.8 dollar. All right. So $1.8 is that a thing? Let's let's just go with the example that the ATR is $1 because I cannot move this chart. Which it assume, right? Because we have as rand respected statistical edge at 96%. And it's going to be different depend on the time range of the section you are selecting. It also is going to be different by weekday, like Monday, Tuesday. It's going to be changing. But Monday so far is giving us the highest probability. So in that case, if we are trading New York section and price going down to like the bottom of the ATR and then it forming some kind of reversal pattern that you refer to trade, at that time that reversal trade that reversal pattern, it doesn't just a setup, it doesn't just a pattern with shift in market structure, or it's just not simply a trade based on something, but it actually have a location at the bottom of the ATR itself, and usually we have a price respected the ATR 25 out of 26 day, and even in a bigger time scale, it's still respecting the ATR like 89% of the time. So if we are at the bottom of the ATR and we finally see price forming, let's say, a wedge at the bottom at the ATR, it is so powerful than any other wedge you are seeing down the road randomly on the chart. Or let's say price forming double top or double bottom, or it's just simply forming a double confirmation like a wedge, then price then price trading down here, and it form like micro bottom. If you're trading bar by bar like price action trader like Alpro, then when you're reading the price and you have a price location is at the bottom of the ATR, you are improving your trading edge tremendously, and it actually makes things so much easier to trade because when we have something with that kind of probability to support our trade, it should not simply a pattern and anymore. It is a pattern with a data behind it. So when it's gonna this is one of the example of using ATR. Another example ran to ATR by weekday. So you can see the breakdown right here. This is one of the thing I like the most, like I told you in the beginning. The thing is, if you are new to trading or if you don't really know how to develop an edge, the kind of breakdown actually gives you like a way to brainstorm, to understand how to use ATR more than just a measure. So let's say with 5 year data, we have a Monday usually move 70% of the ATR. Wednesday on average like 81% of the ATR. And any of the number can be used to trade. So let's say on Monday you are seeing price trading like 100% of the ATR, then you know that it's not really a normal behavior. So if you are trading mean reversion, you are out trading out of the ATR range as price already like one 100% of the ATR, and you want to trade back into the range, then you're going to wait for a reversal pattern to form. Or let's say you're trading with the trend, and let's say on Wednesday you're trading with the trend. At the time you have some kind of retracement entry pattern, the ATR is around 40% of the average true range. So at that time, when you have a data like on Wednesday, price usually move in New York session 81% of the section ATR. Then you're going to note that all right, so it's already currently priced around 40% of the ATR, so it still have a room to move until 81%, which is the average. So we can actually take partial at this level or close everything up the table, because that is quite a reasonable place with data behind it to actually make a decision to get out instead of trying to hold on for a bigger risk to reward. Sometime price gonna go like really exceptional, like out of the ATR, like 200% of ATR, 300% of ATR. But it's not really something that happening every single day. And if you want to be consistent, you want to focus on something normal, something that repeating every single day. You don't want to aim for big RR. You don't want to aim for exceptional. I mean exception. You don't want to aim for a fixed risk to reward and expect that market is going to behave in your favor, because it's not going to do so most of the time, and more times than not we're going to be disappointed. So that's why data is powerful if we know how to use it. But at the same time, if we are going near the close of New York section, and so far the ATR is only fluctuating around 40 to 50%, you still have to close the trade, because when we still if we think like price still have a room to move, yes, but the time is up. We are moving out of the New York section, and when we trade based on data behind the number, the time is very sensitive. We need to know that if we are trading based on data from Asia, then we need to respect the Asia time brand as well, and getting out before the data is kind of expire. Hope that makes sense. So using the number is more like in a common sense way, in a logical way, not like all right, I'm gonna see this, I'm gonna do this, I'm gonna see this, I'm gonna do that. It's more like the optimal is the data is gonna optimize yourself as a trader, and it's gonna make your decision is so much more peaceful, logical, with common sense, with some statistical edge behind. With enough practice, you will not really feeling much emotion anymore. not because you don't have emotion, but because you know what you are doing. And yeah, hope that makes sense. So what you just saw me doing is just trading the gap fill. It kind of a quick scout within a 5 to 10 minutes of the open. I think a lot of prop firm actually doesn't like it at all because the thing is kind of manipulation and stuff. That's the reason why I trade on my IC market instead. Somehow, light count is always the best. So I want to talk a little bit about the gap fill thing. Like I mentioned earlier, is about we know that most of the time, 95% of the time, gap is going to be filled on go. But it doesn't mean that it's going to have the same success rate on other instrument. This is where you need to like doing the research on the pair on the market yet that you are trading. And then the problem of high probability statistical edge is that sometimes people got overconfident and they ignore the risk management factor, or they don't know the time where most of the gap is filled. On go, if in a session the gap not filling and somehow it will form as a resistance level instead of getting filled, that is actually another indication that market is going to go the opposite way and it's going to be a little bit aggressive, especially when it comes to London section or New York section. On IC market, you can see that I shot here and I cover here. Unfortunately, the gap starting from here. I why didn't I tie all the way down here at the bottom of this gap instead? I'm gonna show you. So on IC market, you can see that the gap is kind of starting from all the way down here, right? But in trading view on DAR as broker, the gap is kind of something like this. So instead of targeting based on IC market data, actually targeting based on the gap up on there. The reason being is that the data that I view on my SID it is from OnDar. So I'm going to respect the data, the source that I pull the statistic from. Otherwise, if you sometimes you got kind of mis mismatch in the way you trade because you're using data from somewhere else and you're trading on another platform that have sometimes a different opening time or different closing time, or sometimes it's even different time zone and stuff, or they have a kind of different liquidity provider, or some brokers show 4 digit, some brokers show only 5 digit, something like this. And sometimes it's kind of small, but it can really affect your hit rate. And when you are trading based on data, one of the thing I learned the hard way, especially with the high win rate stuff, like gap fill or many other trading edge based on data. If it's too good to be true, you need to find a way either validate things manually or find some way for you to actually see things from different perspective, because sometimes the data can be wrong. And just like AI can be wrong. um i I faced multiple times, if not a lot of time, AI actually help me to pull the data, but it pull statistic all wrong. And this is the reason why the data sometimes is just as good as the trader who try to use it or who try to collect it. You can see I take profit right here. I'm not trying to aim for the bigger thing. If you want to aim for a bigger piece other than just filling the gap, then you need to ask yourself this question. After filling 100% of the gap, what is the extension or the deviation that price have a tendency to go for? Let's say you check 100 times and 90% of the time, say they just example, say not there, 90 out of 100 times price move not only 100% of the gap fill, but it moved like 150%. That means after filling the gap, it have a tendency and momentum to continue to another like 50% of the gap and around here. So when you ask yourself that question, now you allow yourself to have a chance to seek for new possibility, new trading edge. And it requires sometimes if you are a coder, you can actually find a way to do it, and you can have something for yourself that not available too popular, and you can trade based on that. So trading edge based on statistical advantage, it a kind of interesting way because sometimes not depend on how good you are at a developer, but sometimes it's more about the experiences you have as a trader and how creative you are, so that you know how to ask the right question. When you know how to ask the right question, not only that the AI that you're using is going to be learning from you, and it's going to go into be smart, just just you are. And in a way, you maybe you are not a quant trader, you're not a developer, you don't know anything about coding, but when you are creative, somehow you're putting yourself into a position of a quant researcher, which is seeking for new possibility and seeking for new opportunity in the market. And yeah, they I think we should stop there and we go to the next thing. So the next things I want to talk about is seasonality. I want to go a little bit overview first before we actually try to dive deeper. So when I first started trading, I trade forex, and and I learned from gurus and try to hit high risk reward and stuff. So the thing about that is that the euro USD in a time horizon of 24 years, starting from 2000 to now. So you can see that it is a return and the average return of euro against USD. So if you notice that the the last line right here is kind of, you can think it in terms of percent of closing at positive. So we can see that most of the stock is around 50% on average. And when you trade with statistical edge, I don't think you can actually utilize the edge that have a probability of less than 70%. It's quite difficult. The only thing that seems to be reliable to form a directional bias December. And you can see on December, 71% of the time, the monthly candle is going to be close positive. So that is interesting information that you can actually use to form your buyers and to favor the long entry more, not in terms of go all in and doing stupid stuff, but it's more like if you are having long trade and short trade during the month, then you have a tendency to favor and hold your long for a bigger reward. And when you have a short trade, you know that the theme of this month is kind of bullish in the past, and you don't want to hold your shot too long, going against the probability of seasonality in this case. But on the other month, you can see that you have a kind of a balance between positive and negative close. So you can actually expect that we can actually expect that it's pretty random and very hard to predict. One of the core thing about seasonality is that on currency pair like forex, it doesn't work very well, and it doesn't show a lot of advantage in terms of statistical edge. That's the reason why if you use a trend following or trend based trading system and you're trading swing things on currency, I think it's quite crucial to understand fundamental because without a without an edge or understand deep about economic and the fundamental background, it is quite hard to actually hold it the correct pair in terms of technical analysis. So if you're a trend trader and you are not really good at fundamental, it is better to trade forex as a day trader. But if you are kind of living in US or UK, English or Morse language, and you're really good at reading COT data or reading news and fundamental and understand multiple perspective of fundamental analysis or modern economic and stuff, is give you advantage in terms of data, but not data like number, but data in terms of inter-analysis between different factors of the economic. So do you, so I just give you some kind of example of reading the data in terms of seasonality, monthly stats, so that we have an idea that all right, so is really a big picture how we are going to deal with it, how we are going to trade it in the short term. If you are trading it long term, then how can we actually utilize the thing? So on the internet, you can hear that more people say weird thing like December is dangerous to trade. But when you looking at the stat, you actually seeing that December actually give you kind of 71% of the time it close above the open, the monthly open. So it actually give you better edge than the rest of the year. So what does this mean? Does it mean that when you hear something like you should do this, you should not trade on December, blah blah blah, because your influencer told you to? Even me told you to do so? I think it is bad to actually verify the data yourself and see that it's just if you're trading Euro USD and you are kind of having a second thought, then just validate on seasonality and you can see that it's pretty trending. But if you're trading using range and stuff or mean reversion, you're gonna be quite careful with December. I hope that makes sense. We're going to review some other stuff like, let's say, Go. Go is quite interesting. One of the thing about seasonality is that it tends to work pretty well on the product that not made by human, like currency. It is kind of controlled by the government and stuff. But Go, it is still controlled thing by human, but it's from the nature and things that from the earth. They tend to have a natural tendency that repeat quite often, more times than not. So that is 24 years of seasonality. So if you're looking at this, you can see that seasonality of gold is quite bullish on many months, and December is where it kind of is the most bullish. If we look into December in terms of two segments, the first 2 weeks and the last 2 weeks of December, then you're gonna see that on the last 2 weeks, people call it seasonality. It's like the seasonality pattern as Santa Claus, and it have a like 90% of hit rate or more than 85% of hit rate, and it's quite interesting. And it had been like that for 20 years or so. So you can go really kind of deeper into seasonality to actually form a directional bias or knowing that what kind of range, what kind of direction that market tend to have and how I should utilize it. So here is the tool that quite interesting. I want to show you that from 19 December to 31 of December, the where Christmas happening. So from the open price after this period, usually price have a tendency to close above the open 84% of the time. So like I mentioned earlier, when you see some kind of high probability license, you need to validate it first before you actually use it because it always a different calculation between data and stuff. So let's say if they are using this data from future broker and you're trading on forex broker, or if they are using the same sector but different brokers usually with different liquidity provider, it usually have some kind of different variation of the statistical edge. But I used to trade a seasonal pattern that have a like 90% of the time when 90% of the time it happened. But then I look in but then I trade and it fell miserably and then I look into another source of data like or four more source of data and then they show significant difference in terms of the probability. So it's really important to validate the high win rate strategy or the high win rate statistical edge. And really one of the important tip about seasonality is that I don't know if I'm wrong or right, but I think randomness can actually generate a consistent pattern for years. And what I mean by random pattern, it usually has kind of really good closing streaks or winning streak in terms of price always kind of positive for like 80-90% of the time. But eventually, when you trade that pattern for the next 10 years, you are going to see it fail and fail and fail and fail. So what makes a difference between a random pattern, even with high win rate percent, and the one with real real consistent in the ways they appear in the market as seasonality pattern. So if you remember the earlier example about seasonality in Euro against USD, do you remember in December it usually have a bullish tendency around 71% of the time with 25 years of data set. And gold, it have a tendency to raise in the second and the fourth week of December as well. So the things that makes this pattern different from other pattern is that usually at the end of the year, company usually try to move USD out of the states, and they kind of do things that benefit some in terms of tax. And after the end of the year, they will kind of buy back their USD. And I'm not really an economic thing, but if you look into the reason behind why gold usually raise on December, holidays is an obvious reason, but there are other factors as well. And when a seasonality pattern have a reason behind it, it usually gonna perform quite consistently. The chart that's showing that if you took kind of buy at the start of the seasonality pattern and sell at the end of seasonality pattern for the past 25 years, you're gonna have a kind of equity curve in your in your capital, and it's kind of big, isn't it? But like I say, the pattern can be very attractive, but it can be deadful as well. Like I was very confident in one of the pattern I play is quite big, and I pay the price. So I just want you to remind yourself about using the pattern. If you are trading solely on this, you need to understand that how to apply risk management and how to using other source of data to actually validate the seasonality pattern, and how to using other correlation or other statistical edge together to maximize your profitability but also reduce the risk and protect your account. It is there plenty of pattern that you can actually see if we using this one. I think we're going to see the trend more obviously. You can see the sharp drop like this here, sharp drop. During the time, it is quite interesting is that if you're trading basically day trading and you're trading on the periods, you need to be extremely careful because they have a tendency to be quite bearish. Sometimes we don't know exactly the reason behind, but we know that the stats is quite bearish. It's like 72% of the time it closed below the seasonality open. So somehow during this period and price kind of go really bullish in a way, we can actually play reversal pattern when price reaching a certain ATR level or a certain seasonal range. But overall, I think I don't want to go too deep. So let's talk about SB 500s. So it's like this U.S. stock market, U.S. 500s. You can see that it's quite interesting to see the tendency of stock market is most likely bullish. That's the reason why sometimes you saw some stock trader focus purely on long only and looking at the statistic, you also don't really want to play short unless you have another data or another play where you feel confident, another pattern where you test it and you know how to play. Otherwise, if you are a new trader and you're looking at this, probably it's not really a good idea to be short on July. It's like for the past 6 years, July have been bullish close for like 100%. So basically, if you just buy the open of the monthly candle and close at the close, you're profitable. And sometimes that's all it takes. Sometimes we complicated the edge, and sometimes we try to do more than we needed. And sometimes less is more, obviously. Here you can see the 83% of bullish rate. And let's say throughout the year until July, if price keep going up and you are expecting a retracement, you can actually expecting a retracement in September and October because the theme usually bears. But if you are seeing price pushing really hard on June, but you want to trade like sell the high and you try to go against the trend and catching the top, you don't want to do that because it's extremely bullish periods in terms of seasonality. And even you can do that and you make it like successful catching the top and somehow you got the exception and you market dumb and stuff. But looking at the stock, looking at the data, I'm gonna say that there are trades that you can do it, but it doesn't mean that you should. And there are trades that sometimes everyone is losing, and it's nice to win and going against the trend and going against the whole world and you win. But all the time when you lose, it's gonna be painful and you're gonna lose and lose and lose, going against something that strong as this. And today we are talking based on data. We're not even talking about chart pattern or other factors like fundamental and stuff. Here is another extremely interesting piece of data that I collected quite some times ago. And this I collected manually because it's quite complex. And I think that unless you are quite good at coding and developing, I don't think you can actually extract this kind of data easily. So when I looking at HK50 Hong Kong market and I turn it back, I am looking at period from 18th of December to 20th of January. So it's like 1 month of time. And when I look where in this 1 month period price form the low of the range, and then I see 20 December, 20 December, 21 December, and 19 December, and then 18 December and 23 December. And then looking at the high of the range, the 20 January, 20 January, 20 January, 21, 18, 18 January. Do you see the pattern? So the low of the range usually form as the start of the seasonal pattern, and the high of the range usually form at the end of the seasonal pattern. So this allow me to simply buy and hold 1 month, and that is a strategy based on data. If it happened once or two times, it's very not maybe not tradable, but you can see it happened in the span of 7 years. And the low of the rand it happened exactly like within a short period of time, and there's some kind of repetition in terms of the same day and very the day before, the day after, something like that. And here on the high of the rand, it formed like 3 times in a row in the same like kind of the same day. And the average true range of the periods is 2,700. So we know what we are expecting. So in term price go to the average true range before the end of the seasonality, I may just close the trade because I know that the expected value in terms of profit. So you can see that this is just another example, and I don't think you are going to see this data anywhere else because it is from my very personal channel and I don't share it with anyone. And I actually collect the break-even day as well. So the break-even day meaning that after prime move past this day, it tends to like never return to the entry price, which means the opening price. So after the period, if I found some kind of similarity or some kind of range, it allowed me to move my stop loss to break even, not based on feeling, but based on data and based on timing with statistical edge as well. So sometimes it is very hard to, let's say this is the final gain, and this is the maximum losses. So the maximum loss is kind of where price is going to move down before actually move up. So if you are a day trader and price forming kind of it's like it travel to this kind of max loss area down below the opening price, and then it forming some kind of reversal pattern. That's where you can actually try to achieve extremely high risk reward by trying to buy as the kind of bottom. So from this data, I think I'm going to end this video as well. I think it's quite long already, and I don't know if you are actually enjoying it because it's quite it's quite personal to me, and it's quite a lot of things. Even I consider they are invaluable. Like it took me a lot of time to collect the kind of experiences and lesson, and I don't think I see anyone actually sharing it without charging you some money. So I actually expected this video to be different, to be honest. I have not even started to share the thing that I wrote in this note, but somehow when I talk about data based decision and developing a trading edge, it seemed bigger than I imagined. And even I try to make it simple and easy to understand. I think that some data is quite not quantifiable, and some data is very quantifiable. And sometimes it's not the data that make you a profitable trader, but it's more like you learn the data, you convert it to a certain thing that you can action on. In trading, the smartest people is not necessary to be the most successful, if not the opposite, because they tend to be overcomplicated things and they tend to observe and have a lot of data in their mind. And when you observe so much, it's like when you let so many numbers sink in, or you try to over optimize things, it can really be a huge obstacle in terms of making the right decision at the right time. At the right time is a keyword right here. And that is what I'm trying to do I do with my life personal trading. I not only for me right now it's not only about making money, but it's more about how skillful I am in terms of execution. And sometimes less data, but confident in terms of execution and managing the trade correctly. It always leads me to profitability, and that's what I am training every single day. I'm still making money, but kind of a little bit than I, I used to. But I am aiming for building a very strong and stable foundation because I know how scalable trading is, and I know that if I have a strong foundation, it's just a matter of time before I trade bigger. For a long-term trader like me, I trade a lot of big account, so it's kind of even harder when you trade one lot, 10 lot, 20 lot, and then you go back to micro lot. It's just harder than scaling up. Scaling down is a journey of grounding yourself, knowing your place, knowing what you should do, knowing that without strong foundation, without strong root, you're not able to grow, you'll not be able to be the trader you always want to be. And that is kind of my journey right now. And I think even I tried really hard in this long as hell video to talk about how to develop edge. I don't actually give you my edge. I give you a different unique piece of a certain edge. And it's more like our job to condense the data to actually make decisions based on it. It's not simple like, or is it 90% gonna buy? Is it 80% gonna sell? I'm not even talking about the difference in terms of risk management that required for different personality or different kind of strategy or market environment. Sometimes it sounds simple, but when I go and talk about it, it just expand. It makes the video just get bigger and bigger and bigger. This is not a YouTube optimized video. That is really something like I wanted to do because YouTube optimized video, you get a general advice without anything to back it up, without any thoughts or feeling, and all you need is paying, and then they will share more. And you want more, you pay more, and then you want even more, you pay for one-to-one mentorship, or you want to in-person mentorship, something like that. And it's not wrong or the right way, but at the end of the day, it's the biggest trading edge that no one can take away from you, and it's you. All the data is just tool, just like indicator. They help you to be able to quantify things in numbers and understand the data allow you to understand the pair, the market that you're trading. Understand the data allow you to not only see the market like moving, but you know the tendency of its weekday, even to hours and deeper minutes. But the data doesn't bring true consistency. True consistency lies within how you utilize the data and turn it into fast action. It's like your second nature. It's like, all right, I see price go to a certain level of the ATR. For me, at that level, at this time, here is what I usually do. I just do it. And at some time, it feels kind of normal. It feels like a me reaction to the market, but that reaction is built up by butting thousand of reps, thousand of execution, and it just get easier and easier over time. And the more I do it, the more I will be able to slowly improve and collecting. I mean, journaling. We don't journal to see how much we are making. We are journaling to make our edge sharper, and until we rely it, journal will never make us a better trader. We don't journal to show on Twitter how much we are making. We don't journal to see a beautiful calendar without losing day. We are journaling by collecting the variable that we can quantify or not quantifiable, or some variables that only us can quantify. And then from the number, we create a certain filter. We create a certain stats that can actually help us to bit by bit make our edge sharper, and that is the true path to build a trading edge, to build true consistency. And that is my take on building a trading edge. It's quite long already, so probably I only 5% of people gonna see this video into the end. But I hope that you know the beauty of the data by now. You know the beauty of seasonality by now. You know how to find more about data. You know that there are 1,000 ways to approach data. It all depends on perspective. The data is not like something magic, but your decision is what makes the data magic. And do let me know if this video is helpful for you or not, because I put so much efforts on this. And yeah, just hopefully it resonate with someone out there, and probably gonna take some rest after this video. After that, I will share what I wrote in here. A lot of beautiful things, at least to my perspective. Alright, so good luck and good trading. I hope that you find something useful in the video.